Thank you all for dialing in. We have a large number of people who have registered, and we will allow a moment for people to join. Due to the high volume of guests, we will not be taking questions from the audience and would ask that you please direct all questions after the call to your CBA Relationship Manager. I will now hand the call over to Anthony Kritikides, Managing Director of Institutional Sales at CBA. Please go ahead.
Good morning, everyone, and welcome to the August RBA update call. I'm pleased to be joined here by Belinda, CBA's Senior Economist, and we're going to talk about the result of the RBA meeting yesterday. So, Belinda, about a month ago we spoke, and there was a shock outcome. But yesterday the RBA delivered what we expected, and they cut 25 basis points to 360. First of all, what happened in the last few weeks for the RBA to change their mind and deliver a cut, and what did you think about the statement?
Thanks, Anthony, and good morning, everyone, for who's joined today. As you said, it was a very much as expected RBA rate cut yesterday. I think reflecting on the past 5 weeks and that shock on hold decision in July, the RBA just wanted more time and more data. And what we've seen over the past 5 weeks is, particularly on the inflation side, it confirmed for the RBA that inflation is moderating as expected. And I think they've even gained confidence that looking forward, underlying inflation, trimmed mean inflation, should hit the midpoint of their target band. So they can, and they did, continue with their very gradual and cautious easing cycle. So that led to that rate cut in August. And from here, the RBA is expecting inflation to continue to moderate a little bit around the midpoint of their target band. The unemployment rate's expected to remain around the current levels, maybe lift a little bit more. And the economy should improve, although not as much as what they had expected at the last forecasting round back in May. So overall, just the feedback from the Reserve Bank over the past 5 weeks, and certainly in their commentary yesterday, is they do sound very confident. The upside risks to inflation are now in the rear vision mirror, so that easing cycle can continue. And then I think the debate now is how much more easing is there to come.
Thanks, Belinda. So, I saw the note about the CPI, but equally, there seemed to be some people who thought it was maybe a touch more negative when it comes to growth. Do you want to comment a bit about that, and is that in line with what you're seeing with the data the CBA has?
Yeah, so probably the biggest surprise for us in the forecast yesterday was that they did downgrade their GDP forecast. So we and the RBA had looked very similar in terms of our expectations around an economic recovery here in Australia. But yesterday, they did downgrade growth, mainly because of their productivity assumption. Now, this is where I think the decision yesterday gets a little bit more interesting, is the RBA lowered their short-term productivity assumption, which means potential growth in the Australian economy is now lower. Now, why I say it's really interesting is obviously productivity is front and centre of everyone's mind at the moment, coming up to the productivity summit that's going to happen this month. So they lowered what they're expecting productivity could do in the Australian economy over the next 2 years down to 0.7%, which means they now see potential growth in the Australian economy at just 2%. And that is quite a bit lower than where it has been and their assumption has been in recent years. So we are expecting a recovery here in the Australian economy. Growth, if we remember at the moment, is just 1.3%. They have it lifting to 1.7% by year end. We're slightly more optimistic than that. And the main reasons why we have a slightly more optimistic view is we're getting some more green shoots around the consumer. So what we've noticed in our internally generated data, particularly our CBA household spending insights, is we have seen more consistent signs of spending the last couple of months. And I will note we do release our July report this Friday, but there does seem to be some improvements coming through the consumer. We know real households with disposable income growth lifting, same as wealth. The labour market remains in a solid position. So that really drives our thinking that growth might come in a little bit better. And then that means at the moment, we don't have further easing in our forecast in 2026. We have one more rate cut in November this year. But then unless we see a deterioration in the data and we don't see that pick up that we're expecting, then the RBA will have to keep cutting into 2026.
Before we talk about market expectations of that, can we just spend a bit more time on the data? So you mentioned the labour market. It wasn't a particularly good labour report recently, the unemployment rate ticking up. So is there any stress there, or is this something the RBA and yourselves expected?
Yeah, so we have been saying for quite some time that the labour market had been outperforming where the economy has been, and a lot of that outperformance has been coming from strength in the non-market side, so that's education, health, public administration, all the sectors tied to the government sector here in Australia. It looks like that is starting to slow. We saw that in the first quarter of this year, and you are right, Anthony, the last 2 months of the labour market data have been softer. We've effectively had no growth in employment combined in May and June, and the unemployment rate now sits at 4.3%. The RBA certainly have started to tone down their language on the labour market a little bit, so they certainly...
The conference is now being recorded.
It certainly was characterised yesterday as the labour market conditions are a little tight, although have eased further in recent months. So for us, it does show that the labour market has been showing maybe a few more signs of softness than what the RBA expected, more in line with what we've been thinking. But I think when we start to talk about where we go from here, and if the RBA would ever consider doing back-to-back rate cuts and cutting the cash rate further in 2026, I think the primary driver of that will be a further deterioration in the labour market. So as I noted, the unemployment rate is sitting at 4.3%. That's the peak where we expected this cycle, same as the RBA. So if we do see that unemployment rate lift above 4.3% and stay there, that's when we start to talk about if a September rate cut is on the cards, as well as that November rate cut that we're expecting. And then we start to talk about that cash rate getting back down closer to 3%. So for us in the near term, the labour market data is incredibly important. And obviously we get an updated view of that tomorrow.
Before we move on to the expectations of further cuts, when you have nearly 500 people on the call today, a lot of our clients are from the retail sector. I'm sure that they'll can't talk on behalf of all of them, but I'm sure a lot of them would say that it's still pretty tough in the retail sector, and certainly the retail sales numbers haven't been great. But you have seen in the HSI and data, internal data, that there has been some sort of pickup. So where is that being focused on mostly, this pickup in retail?
Yeah, so it's a good question. So what we've noted in recent months, and there's a difference between what we're seeing in terms of the categories of where people are spending, but also who is spending. So particularly around that second rate cut in May, what we saw are those who have a mortgage and those who rent have started spending more than those who own their home outright. So there does seem to be a sense that lower interest rates, lower inflation, and obviously that those tax cuts we got over a year ago now are starting to make a difference in terms of spending momentum. So those who are a little bit younger and those who rent and have a mortgage have lifted spending. That's predominantly been on the discretionary side of the equation. So we have seen a pickup in hospitality and recreation. What we've seen generally in our data is like big sporting events have drawn people out to spend. Travel's still really up there, eating and drinking out. One other area that we've seen in more recent times is more spending on communications and digital, so particularly the Nintendo Switch back in June. did see people come out and spend. So it really just reinforces to us that we've had pretty deliberate consumer spending over the past 12 months. People spend when there's an exciting event or when there's a new item or where there's discounting and promotional activity. But over the last few months, we've certainly seen more consistent signs of a pickup. So there are some green shoots coming for the consumer and for the retail sector, but there is no doubt that this time around it's taken longer for that pickup to occur. And what we've also seen in our data is this clear preference to continue to save and pay down debt. So flows into offset accounts and redraw facilities still look a lot stronger than what we saw in 2024 and even what we saw during those 2 COVID lockdown years as well.
The other thing, Belinda, that happens when there's rate cuts is the property market tends to start performing. It seems like anecdotally it seems to be getting stronger, and auction clearance rates in the big cities seem to be improving. So any comment about the property market, and would that have had an impact on people's spending over the last few months?
Yeah, so our chief economist and one of the analysts in my team did update our housing view last week, so I'll encourage everyone to go and find that. But we now are expecting more strength in home prices this year than what we had forecast earlier in the year. So we've upgraded our home price forecast for a 6% lift this year compared to 4%, and then another 4% gain in 2026. And you're right about what you said, Anthony. It is very much a momentum market, the housing market. So interest rate cuts generally do spur a recovery in home prices. That's what we've seen. Sentiment's lifted, auction clearance rates have lifted, home buyer sentiment is lifting. So generally when we look at past home price cycles, and if we assume around 100 basis points of rate cuts, that generally should lift home prices by around 10%. So that's very much in line with our forecast this time around. A lot of the improvement more recently continues to be in those mid-tier capital cities, Brisbane, Perth and Adelaide, where population growth remains quite strong, listings remain quite low, and that's driven home prices to continue to lift there. More recently, though, we have started to see Sydney and Melbourne turn around as well. That's what you would generally expect in these interest rate sensitive parts of the Australian economy, is that reaction to home prices. So that home price cycle is still underway. We're expecting it to continue through 2025 into 2026. There are some headwinds, though, for the property market. The first one, of course, is housing affordability or lack of affordability. So we do think that will continue to be a constraint on the market. We also have slowing population growth as well. So net overseas migration is normalising. So some of that heat around the demand side of the equation is certainly coming out. But overall, an improving housing market lifts household wealth, and that can also be a catalyst for an improving consumer outlook as well. And that's certainly what we're expecting in our numbers.
Thanks, Belinda. Okay, so now they're real tough questions. So the market's pricing about 8 basis points for September, so probably about 30% chance of a cut, and then pretty much a full cut and some by cumulative by November. So certainly market's convinced that they're going to go again in November, and then into the new year there'll be another one. So what are our updated forecasts and thinking post the statement yesterday?
Yeah, so we definitely do think they'll cut rates again in November. If we look at the cadence for rate cuts this year, they have really stuck by this quarterly cautious cutting cycle. So we obviously got the first rate cut in February, the second rate cut in May. We were all wrong in July. They waited until August to continue that quarterly cycle after the quarterly CPI. So the next most logical month for a rate cut is November. So that is our expectation. What could shift that, of course, and bring a September rate cut as more likely will be very much data around the labour market. They will receive two labour market prints now ahead of that September meeting. So as I noted earlier, if we do see a further deterioration in the labour market and a sustained lift in the unemployment rate, September could be likely for a back-to-back rate cut after the decision yesterday. If we don't see that, if we see the labour market kind of continue around its current path with that unemployment rate of 4.3%, then November is the most likely option for the next rate cut. Now, when we look at the RBA forecast that we got yesterday, it is predicated on a couple more rate cuts. So that's why the market obviously is still expecting them to cut into next year. That does remain a distinct possibility, although, as I said, at this stage, we are slightly more optimistic on the outlook for the Australian economy. We have the economy improving a little bit quicker than what the RBA is expecting, really driven by that consumer story. So at this stage, we don't think we need to take the cash rate lower to meet our forecast. But I think really what we're watching for very closely in relation to that is just how the labour market performs. And if we do see risks to the downside for inflation, so if inflation does look like it's going to miss on the downside, then the RBA will continue to cut into 2026. So at this stage, we're expecting one more rate cut in November with a definite risk that they could cut again in 2026 just to ensure that inflation continues to hit the midpoint of their target band. There's still a lot of uncertainty, of course. We haven't even talked about the global outlook, Anthony.
I was just about to go there,
okay. I preempted you, but that is certainly one thing that could also shift the RBA's view.
Let's go to the global picture quickly. So obviously there's a lot of news out of the States. They've had some relatively poor data as well, including the payrolls print that cost the head of the labour statistics their job. And just generally, China, there's still concerns about the state of their economy. European economy is relatively sluggish in parts. So the global picture isn't great. Tariffs are still front and centre, and then that hasn't stopped that story. So global trade there's still a big question mark over global trade, which obviously has a huge impact on Australia and certainly having an impact on the Aussie dollar. So do you think the backdrop would be, the global backdrop would have entered the RBA's thought process when it comes to what happened yesterday, cuts yesterday, and what they're thinking for the next few months?
It is definitely still front and centre of the RBA board's mind at the moment. I think one thing, though, I would note is back in May, where the RBA certainly entertained ideas of a 50 basis point rate cut, the global situation was very heightened. Remember, we just come after Liberation Day. We hadn't seen the trade deals that we've now received through a lot of the major economies with the US. So the downside risks were a lot more heightened. Now moving forward to August, we've obviously had some major trade deals between the US and Japan and UK and Europe. There's another pause been announced between the trade tensions between China and the US as well. So that is less heightened, but the outlook does remain uncertain. So I think when the RBA is thinking about things in terms of the global outlook, they're still expecting a weaker global growth story this year. And that really does create, I think, what we've been calling an uncertainty tax. Heightened uncertainty offshore means you could see businesses delay investment plans. Even households can be impacted by that uncertainty offshore. So that could weigh on activity here in Australia, but we are yet to see really any hard data around that. In fact, what we've seen more recently, particularly in the business survey that was released yesterday, is a pickup in confidence, a pickup in conditions. We're also actually seeing that in the PMI data as well. So there are some better signs through these survey measures, but I do think that global uncertainty will continue to weigh for some time. And then obviously that fall in global growth this year could impact obviously on our major trading partners. But at this stage, the economies have held up reasonably well, including China, probably performed a little bit better than what we had expected. I mean, we're looking at things like steel demand and the iron ore price, and they're performing largely how we expected. So I think that main transmission mechanism at the moment is still through that uncertainty tax. And there's been some limited signs of that coming through the Australian economy.
And just from a market's perspective on that, the fact that the Aussie dollar has been stuck around 65 cents at a time when the US dollar is sold off pretty heavily against most major currencies, and you've had the stock markets at all-time highs. So generally speaking, risk on in the market, you would normally expect to see the Aussie quite a lot higher. So I think the Aussie's taking some of that uncertainty tax, so to speak, and that's why the Aussie's really struggling to rally.
Yeah, certainly there's been a lot of interest in that. Our FX team have written just a report this morning, actually, just looking at, is the Australian dollar still a risk-sensitive currency? So certainly something that we're thinking about also.
Yep. Just finally, just sticking with the offshore piece, just for a second, you've obviously had a rate cut in the UK, which was widely seen as a hawkish cut. The Fed look like they're going to cut soon, possibly because of the slowing economy, but possibly also political pressure. But the global central banks are looking like they're back on rate cut cycles, maybe a shallow cycle. But would that do you think that has an influence on how the RBA thinks? So you talked about the global piece, but do you think what central banks are doing offshore has an impact as well on their thinking?
Look, yeah. So one of the things the governor said again yesterday is we lifted the cash rate less than what we saw from other global central banks. So we may not need to cut as much as other central banks. So I still think the RBA view themselves on a different trajectory than offshore. So you remember countries like the UK and the US, their cash rates went closer to 5%. We went to 4.35. So they're now in a deeper cycle to get the cash rate back down to around neutral. Some of these economies have had much more stubborn inflation as well. UK is a primary example where inflation continues to print a little bit higher than what the Bank of England expected, even though activity numbers have been softer. That's why they're cutting there. The US is obviously going through a very different situation given they're facing those pricing pressures over tariff increases, although this CPI report overnight was broadly in line with expectations and markets are now pricing in the chance of a September rate cut. Our team is less convinced of September at the moment just because we do get more payrolls data and more inflation data before the Fed meet again. So I think the RBA is looking at offshore, but as I said, I think they're still of the view that we're on a different trajectory and that's what they will focus on and how the economy is responding to interest rates here and less about needing to cut to the same amount as offshore.
Fair enough. Thanks, Belinda. Well, we'll probably wrap up here. Maybe just one minute summary for those who, there's a lot of content as always on these calls. So can you just give us a quick summary of where the economy's at and what the official CBA forecast is for rate cuts over the coming few months into the 2026, and then we'll wrap it.
Yeah, of course. So just to reiterate, as expected, the RBA cut the cash rate yesterday by 25 basis points to 3.6%. We do expect the next rate cut in November this year. What could see the RBA cut earlier or deeper than what we're expecting really comes down to the labour market. In our view, the RBA is confident inflation will hit the midpoint of the target band. So any deviation in terms of their gradual and cautious cutting cycle is likely to come through a deterioration in the labour market. So what to watch from here very much will be the labour market data. We do expect, as I said, that one more rate cut in November. Certainly the risk of further cuts next year, but at the moment we're expecting a slightly more optimistic outlook for the Australian economy than what the RBA forecast in yesterday's statement on monetary policy.
Great. Well, thank you, Belinda, and thank you to all our clients for dialing in today. It's certainly a lot to think about. There's a lot of going on in rates and FX, so please speak to your CBA representative if you want any more information. And Belinda, we'll look forward to speaking to you after the next RBA meeting next month.
Thanks, Anthony, and thanks everyone for listening today.